Hello everyone and welcome back to the channel. Guys, in this video I'm going to explain how you're going to manage your cash secure strangle. Okay, I trade the strangle strategy a little bit different because everything that I do in this channel, it is thinking about LTI. Okay, I have this thing here for long time since I started trade options. I built this thing myself. This concept is called the LTI on derivatives, which is long-term investing. Why? Because we are going to see how we're going to manage our covered strangles. But let's say, for example, if you're trading naked puts or cash secure puts or just strangle itself or covered strangle or covered calls or the wheel, all these strategies here that we do ourselves, even credit spreads. Okay, I trade credit spreads that nobody trade the way I do. Nobody on YouTube. I never heard anyone talking about the way I trade credit spreads. Why? Because credit spreads, once one goes in the money, good luck. That trade's gone. You must take a loss. And the risk to reward, 1 to 9. My risk to reward when it comes to credit spreads, guys, it is 5 to 1. That's the way I trade. Why? With the LTI, long-term investing. But in this video, I'm going to show you guys how to manage your covered strangle. And don't forget, go to the description of this video, okay, or any video that you see on my channel. We have all these things here for you guys to download for free. I just want you guys to have all these things for free so you can pretty much start from here, okay? This is not the best ever of all the trading journals available or whatever it is, strike selection, but this will give you guys an idea what I do myself, of course. My stuff is way improved than this. But if you want to get the whole thing, the full thing, just join our Discord group. But as you guys can see, you'll be able here to have this and start this to pretty much log in your covered strong trades. Like I have one here, for example. I took this one here from my original trading journal. Here we're gonna put your put leg and your premium you're gonna receive. You're gonna put your call leg and the call premium you're going to receive. And this will go into calculation your rate of return, which it is up here, okay, at this level here. And if you have to put here 30%, 20%, whatever how much you are required to receive by the end of the year. This is annualized, by the way, okay, AROR, annualized rate of return. Because, for example, so you guys can have an idea, if I put here like I want 150, okay, why it's gone red? Because it has a match my annualized rate of return. But my annualized rate of return, okay, I'm very conservative. It is 30%. So in this trade here, after you place all your input parameters here on these cells, okay, you're gonna put your inputs in here. All this is already calculated. But of course, I've got trade management, final rate of return, all the moneyness of the option, guys, plenty of stuff. If you want to get the full spreadsheet, join our Discord group, and I got plenty, guys, plenty of things that you need to use before you press the trigger. But if you want to download this one here, just go in the description here and you're gonna find, I think, with this one here, okay? But anyway, so basically, just on a quick overview of the covered strangle, very simple. Let's say, for example, we're gonna use the IWM trading at 235 right now. We're going to sell here one short call and one short put, okay? And by the way, it is here, guys, on this video here, okay? Just go and watch this. Very simple. And by the way, again, for those of you that want to learn how to trade option, guys, for free, the whole playlist. And I'm going to keep update this every single week so you guys can have the whole thing, the whole concept, the basics, how to trade options so you don't need to spend any money on any course. Okay, but anyway, back here. So we're gonna sell here one call option out of the money, one put option out of the money, okay? And then from here, we are going to manage our trades. Let's say, for example, we have here a call option at 250. Okay, this is gonna be our short call, and our short put here at roughly 180. Okay, and this is our DTE. Let's call this thing here 30 days. Okay, what if the trade pretty much stay in between the two strikes, is going to expire out of the money? What if trades below the short put? We're going to manage the trade. What if trade above the short call? We're going to manage the trade after 30 days. But what if before the 30 days, the trade trades below the 180 short put or trade above the 250. And this is what I'm going to explain to you guys right now, what you need to do, okay? Very, very simple. So the first thing I'm going to do here, to simulate here, we're going to pick here 36 DTE. Let's say, for example, we're going to sell here 23 deltas, and we're going to sell here maybe 21 delta, okay? So in this trade here, we have 36 DTE. We're going to collect here $4.10 for this trade. Of course, multiply that by 100. This will give our maximum PNL. This is our buying power requirement. It's going to sell one contract for this strategy. Okay, so you go to the trading curve here, or the payoff diagram. So very, very simple. As you guys can see, this is where the stock price is trading right now. Remember, we have here 36 DTE. Remember, in our chart we have 30, but we have 36. So the first thing we're gonna do is, the first trade management, it is to roll, guys, using the Mr. Market in our side. We're gonna use all the bad things that the Mr. Market throw on us for us to manage our trades. And what is one of the first things we're gonna use? Implied volatility. This is the main thing. Remember, we option sellers, we live and breathe volatility. And for those of you that have been trading options for the past 5-10 years like myself, guys, welcome to another 4 beautiful years ahead of us with Trump as a president. Amazing, amazing, amazing. Who doesn't remember 2018, 2019? That was the golden days, okay? But anyway, so the first one we're gonna do, we're gonna roll into volatility, okay? Very, very simple. Let's say that the stock price went up here a little bit, and this is after, let's say, 2 weeks. What you're gonna do is, to capitalize this thing here, you got two options. You can just close the trade, or we're gonna reestablish here, okay? We're gonna reestablish here the same trade, okay? The same trade. Maybe we're going to increase a little bit more the DT. We're going to go from 2 weeks back to 4 weeks this trade. So we're going to sell 2 weeks ahead. But why we're going to have our strike price all the way up here this time? Because, or you can just, let's say, for example, recenter your trades here. Okay, recenter this stock to be at the middle again. Why? Because we're gonna use the implied volatility, in other words, the expansion implied volatility, to capture more premium, so we can pretty much extend our strike price. It's pretty much like this, guys. Okay, all right. This is very low volatility. This is nice volatility, and this is great volatility. You can take advantage of this during earnings, company announcement, whatever reason might be, because you can use that bad pullback or correction of the stock when the volatility increase for you to collect more premium and manage your strike price. So in this case here, if the stock drops, what you're gonna do is, we're gonna drop the sell another DTE here, and you're gonna recenter this trade here. Okay, simple. That's what we're gonna do, nothing else. We're just gonna recenter the trade with another 2 weeks or maybe 3-4 weeks. If your trade got 2 weeks to expiration, just open the trade with 2 more weeks to expire. In other words, go from 2 weeks to expiration to 4 weeks of expiration, using implied volatility in your favor. Okay. The second one you're gonna do is, we're going to roll the untested side. And what I mean is, let's say, for example, the stock went down to 230. Which one it is your untested side? It is the call side, because the put side has been tested. Why now? Why? Because the price is getting close to our short put and testing our short put. So what you're gonna do is, the same expiration, you don't need to do anything. You just close this trade here and come here and place the trade here. Simple. You're gonna close this thing here for, let's say you sold for $1. You're gonna close for 20 cents, and you're gonna buy here for $1 again. Okay, so basically you got $1 plus 80 cents. So you got $1.80 here, because you pay 20 cents here. So now the price is here, and now you got your strike price here. Okay, you're just gonna roll the untested side. If the price starts to goes up, you're gonna close the put, and you're gonna open another put here. Of course, you're gonna have your short umbrella, should I say, okay? But you're gonna collect more premium here. So your break even is gonna be wider, because you have more premium. Because remember, the break even here, guys, it is strike price minus the premium, which it is this thing here. Your strike price is here. This gap here, it is your K minus your P. In other words, strike price minus your premium. And the more premium you collect, the more you're gonna widen your break even. Okay, so the first one you're gonna roll into volatility. The second one you're gonna roll the untested side. The third option for us, it is, guys, very, very simple. Okay, let's say for example you open this trade here with 4 weeks, and now 2 weeks gone by, you have 2 weeks left, and let's say you collect here $4.10. And the stock is trading up this level here right now. And this thing here, if you were to close, we worth $8. So basically, you'll be losing here $4 on this trade. What you're gonna do is, you're gonna, let's say the price gone down to 224, exactly where the put side is. You're gonna get your call option and you're gonna place just here. Okay, just here, pretty much. All right, and for those of you that have been trading options for a little while, what this is going to be is going to be the straddle. In other words, the straddle up the strike price, which it is when the both strike price, the call and the put, share the same strike price. But now, because you're rolling this call all the way down here, all right, you're gonna capture here, let's say $6. So 6 plus 4 is $10.01, and this thing here worth what, $8. And what's gonna happen is, if the price, the current price, stay range bound here, what you're gonna do is you're going to capture here $2 in premium, which is $10 minus $8 to close. But with time goes by, okay, you have your call option here. This thing here might not worth $8 anymore. It might worth, I don't know, $4. Okay, so the more time goes by, the more that option is going to decay and more premium you're going to capture. Okay, and of course, there is a fourth option, but I'm not going to explain here right now, which it is very simple. If the price drop below the put side at 220, you're going to invert the whole thing. You're going to get this call here and bring all the way down here. Okay, the call option is going to be here, right? So you have a call option here, right, below the market, and you have a put option above the market price. So it's completely invert. But you're going to have here, let's say, $20 in premium. And if this gap here, let's say it is 16, and if the trade, the market price close, or the stock price close at the expiration date, in between the two strikes, you're gonna capture the difference here, which it is your premium collect minus the gap. So in this case, $20 in premium minus 16 of the gap, you made here $4. But I do not advise, of course, I'm not a financial advisor anyway, but I don't suggest you guys using the invert yet. Learn how to do those three, which it is using implied volatility. Okay, very, very simple, the concept. Rolling the untested side, and of course, turning the strangle into a straddle. That's one, that's the second one, that's the third one. And the fourth one, I'm gonna make just a different video just for that one, so you guys can have an idea. Because once I make the video of the fourth one, I also want to provide you guys a trading journey just for them, because you need to keep track on how much premium you're collecting, because you need to add all the premium to make sure that your premium is greater than this gap here. Because if it's not, you're going to lock in a loss, and you don't want to lock in a loss anyway. You need to make sure that your premium is greater than the gap of the inverted strangle. But for now, those three, guys, it is enough for you guys to get going. These three are pretty much the simplest and the best ones you can do. Of course, this is not increasing risk in terms of contract, because you can also increase your contracts. Let's say, for example, so you guys can have an idea, okay? Let's say we got here 7 days to expiration, and the price it is right now $235. Let's say it is deep in the money, okay? We're gonna buy here the $240 that we sold, let's say 4 weeks ago, 5 weeks ago, and we had a $15 wide, $255. We're gonna buy here this one here. Remember, we sold the $255 and we sold the $240, and the stock was trading roughly $248. Now the stock dropped all the way down here, which it is trading below the short put. Now we have to buy this thing back. That's why we're buying this one and buying this one to close the trade. So what we're gonna do is, let's say, for example, this is 7 days, just hypothetically speaking, okay? Now we're gonna go to 36 days. We need to sell the 240 and sell the 255. So the 240, we're gonna sell, okay? We're just gonna establish the same strike price, and the 255, we're gonna sell as well. So as you guys can see, we already collecting here a whopping $4.07. Okay, despite the fact that it is in the money, this put here and this put here. Okay, but what we're gonna do is we can drop this call option a little bit close to the money because it's way out of the money. Okay, let's say we got a delta here of roughly 30 deltas. Okay, and you're gonna drop here the put. Okay, let's make this one standard deviation, a little bit less actually. Collect at least some credit. Okay, 26 cents. That's okay. You see what happened? We closed here a put that was in the money. We closed our call that was out of the money, pretty much worthless. We increased our DTE, which was from 7 to 36. Okay, and we managed to reestablish our strike price. So basically, we went from this. Actually, let me delete this thing here. Let me fix this. So we went from this, okay? How can I explain? This is our zero line. So this was our beginning trade. This is our put. This is our call. These were the actually, let me make better so you guys understand. Let me make that bigger, guys. So zero line. So this was our trade, okay? I need more space here. So the price was here, okay? So the price went from here when you establish our position. This is the short put. This is the short call when you open the trade. We had here 4 weeks. After 2 weeks gone by, or we had only 7 days, this thing went all the way down here. So what we did was, okay, we came here. Let me get a different color here. We reestablished here our trade. Right, we established our short put here and our short call here, and we're still collecting 26 cents. And we haven't even increased the number of contracts. That's how powerful it is. Okay, we just did increase our DTs. We went from 7 days to expiration to 36, but we pretty much reestablished the position. And we're still collecting some premium here. We don't pay any debt to roll this trade anyway. But what if we click here, and we increase the number of contracts? What can we do with this? We can collect a massive money in terms of premium, or we can do this. Look at this. We can put here, let's say 1 DT here on the call side, and 1 DT. Can even put the low here down. Pretty much 1 STD, 1 standard deviation of the put side. It's still collecting $2.59, but look how much we decrease our strike price. On the put, we went from 240. Okay, down to 222. We decrease here, guys, 8 points. On the call side, we went from 255 to 248. But of course, because the price dropped a lot, so we still have here massive cushion in terms of protection. Huge, huge, huge. But anyway, hope you guys understand. Okay, I'm not don't suggest you guys increase the number of contracts yet if you don't know how to manage your trades, because for you to increase the number of contracts, you need to make sure at the very beginning you're trading, let's say, 1% of your whole account size. In other words, your NAV, net asset value. Because if your maximum loss is 3%, you might be able to add another contract here going from 1 to 2. Okay, but you need to know when, how, and why. Because if you do this, every time your trades go in the money, you're going to be increased every single time you roll. You go from 1 to 5 very, very fast. And you're going to over-leverage yourself, over-position yourself, and you're going to get margin call. This is not the way to do, guys. Learning how to manage your trades. That's the main thing when it comes to trading option. How to manage and position size are the best thing you can ever learn when it comes to trading options, all right? Anyway, hope this video has added some value to you guys. Don't forget, come to our YouTube channel and download all the things that I just showed you guys on TastyWorks, because you're going to be able here to put it on your trading journey and quantify and qualify if your trades are good enough to open the trades and, of course, to manage your trades. But in a nutshell, these are the 3 things you use to manage your strangle, okay? Covered strangle, cash secure put strangle. The reason I said that to you guys, cash secure put, is because, guys, if the price, let's say, for example, okay, if the price drop below my cash secure put, I might just close this trade. I might double size here my cash secure put, and I turn this into a cash secure put, okay, instead of a covered strangle. And if it drops even more, I'm going to close this thing here, and I'm going to buy again. I'm going to turn this thing here into my LTI, long-term investing. In other words, guys, the Mr. Market would never going to get me. Never, ever, ever. Never. Because there's one thing I have in my side that he doesn't have, which it is time. And if you don't know how to manage your trades with a proper position size, and if you don't have this big T here in your side, not a chance. When it comes to trading options, not a chance. Options in general, derivatives are not product to make income. It's a way for you to use, it's a tool to use to get into your long-term investing. And at the same time, if the market do help us, in other words, trade sideways, things like that, and then we can collect some income. But the main purpose is supposed to be LTI, your long-term investing. Guys, nevertheless, don't forget, if this video has added any value to you guys, press the like button, subscribe to the channel, leave your comments, and all those good stuff, and it'll be much, much appreciated. Don't forget to go to the channel and watch the watch list if you haven't traded option before, and learn at least the basics of trading options. Very, very important. Okay, all the best, stay safe, and happy investing.